This is Dan Dicks here, reporting for Press for Truth, and tensions are running high right now at the Canada-U.S. border as truckers are protesting the vaccine mandate, and this is clearly going to lead to supply chain issues, inevitably leading to less groceries on the shelves for Canadians. Meanwhile, there's geopolitical tension happening right now at the Russia-Ukrainian border, as the Biden administration has just announced they're adding $200 million to the military defense aid to Ukraine, citing potential Russian invasion there. So while all this is happening, gold and silver have actually had a pretty good rallies. They've just hit 2-month highs. So it seems that savvy investors are moving into the precious metal space as a safe haven, which is what they should have been doing all along, which is what I've been suggesting, because inflation and geopolitical tensions are triggering high volatility in the lead up to a meeting at the Federal Reserve coming up just next week. And joining me right now is David Garofalo. He is the CEO of Gold Royalty. GoldRoyalty.com is the website. Sir, thank you so much for joining us once again to give us this follow-up interview. The last time we spoke was back in April of last year. And since then, the world has already become an even more crazier place. As we said, heavy tensions between Ukraine, Russia, the U.S. now potentially getting involved. This is, leading to high uncertainty. And we have the issues at the Canadian border. We have these truckers for freedom about to go on a convoy to Parliament Hill in Ottawa. So this has myself and many others wondering, how is all this going to affect the markets? So maybe we can start with the supply chain issue. There's industry-wide shutdowns happening right now. There's massive restrictions in place, more coming down the pike. What's it been like for you at Gold Royalty, or what's it been like for a gold mining company in general to navigate this kind of new space, to navigate this new space that we've all found ourselves in these troubling times?
Well, look, I'd say that we're not immune from those types of constraints that other industries and individuals are right now experiencing. We're all experiencing inflation input costs, capital costs, particularly on the producer side. And I would say, maybe history doesn't repeat itself, but it certainly rhymes. And this feels like the 1970s to me. I was still relatively young, my early teens, when we last had hyperinflation. But there are a lot of the constraints and restraints and impediments and bottlenecks that we saw in the 70s we're seeing now. Back in the 70s, we saw people line up at fuel stations. We're seeing that again. We had empty shelves in grocery stores back in the 70s because of the lack of fuel to transport goods and supplies. We had hyperinflation. We're seeing 40-year highs in inflation. We're seeing all of those constraints again. We're seeing history repeat itself in many regards. And what happened back in the late 1970s as Paul Volcker came in at the Federal Reserve to start to restrain money supply and start to bring inflation under control, is as he raised interest rates, the gold price continued to take off because inflation was untempered. It was going crazy at the time. And there were a number of years, even as interest rates were going up, when gold prices were doing extremely well. I think we're going to see a repeat of that phenomenon through this cycle. Well,
as we're seeing it right now, gold has seen its highest numbers since November, and this is all happening while inflation is really showing no signs of slowing here. So is there a correlation there? Or in other words, are people still hedging themselves against inflation by buying gold these days?
They're starting to, and so we are starting to see gold get some traction. And the reality is inflation, as it's currently stated in the headline numbers, I think significantly understates the reality on the ground. If you put food in your stomach, put fuel in your car, put a roof over your head, it's not 7% headline inflation. It's well into double digits and beyond. And so we are seeing significant inflation pick up. And given the amount of excess that's been introduced into the system, not recently, but over the last 12 years since the last credit crisis, and it's been unremitting since then, it's inevitable that we would see this kind of inflation. Money supply has increased exponentially over the last dozen years. So these excesses are far and pervasive through the system, and we're going to see a reckoning, I think, in the markets. We're going to see a correction in the equity markets. We're going to see significant inflation. We're going to see wage inflation to catch up with inflation in goods and supplies and services. We're going to be in an inflationary cycle for many years to come. And raising the interest rates by a quarter point here, a quarter point there, is irrelevant in my view, because real interest rates are still decidedly into negative territory and will continue deeply into negative territory for the foreseeable future. That will drive capital into gold, because if you have money in a savings account, inflation's insidious. It eats your capital every single day. If you hold gold, you protect your capital.
Yeah, absolutely. I would agree. And in fact, I think we might be heading into an area of hyperinflation. And I think gold is absolutely the way to go moving forward. But a lot of people don't really know much about what that's like. So from your experience, what's it been like? What sort of risks are involved with, for example, traditional mining from your experience?
Well, we're back where we were, say, even 10 years ago when we came out of the credit crisis, and gold had a good run at the time. It went up 140% coming out of the credit crisis. And we were in the middle of the Chinese super cycle, so base metals were ripping as well. Copper was at all-time highs, previous all-time highs back then. And so we saw producers and developers start to put significant capital to work in new mine development. That drove massive cost inflation in the industry. And I think we're going to see a repeat of that phenomenon, because we've been underinvesting in new mine capacity over the last half a dozen years or so, and reserves have been declining, production's been declining. So there's going to be that catch-up. But unlike 10 years ago, we have inflation in the general economy. 10 years ago, there was no inflation. So today, that'll amplify the inflation we're going to see input and capital costs. And so my view is, if you want to participate in the gold price rally, it's not in the producers. It's going to be in the royalty companies, because the royalty companies offer you that top-line exposure, but completely insulate you from operating and capital cost inflation. And what happened 10 years ago is that the royalty companies and streaming companies vastly outperformed the commodity and vastly outperformed the producers, because they had cost pressures that ate into their margins. And that's certainly not the case in the streaming and royalty business.
Well, let's talk a little bit about that, because your company is called Gold Royalty. So how does the royalty model eliminate any of these risk factors?
Well, when we put money to work with a new mine development or an existing one that's being expanded, we take a royalty back in return as a repayment of the capital we're putting into those projects. That means we get a fixed percentage of the revenue. And so regardless of what the cost structure is at the mine, we get a percentage of the top line. So as the gold price goes up, our revenue goes up, because it's a fixed percentage of that revenue. So operating capital costs, which are likely to inflate, will not impact us whatsoever. The other added dimension of our business is it's eminently scalable. I have 6 full-time employees for a $700 million market cap company. I could have a $7 billion market cap company with the same number of employees. So every dollar of incremental royalty revenue we get goes right to the bottom line.
And tell us a little bit about GROY, or GROY. What does it do?
Well, we're in the royalty and streaming business. We IPO'd just in March of last year, and we started with a small portfolio of 17 royalties on development stage assets through the Americas with a significant mineral endowment. But IPO was very successful. We raised $90 million US on the New York Stock Exchange. And we got a post-money valuation of $200 million. And more importantly, we got a currency. And we used that to help roll up some of our competitors in the space. We bought Ely Gold, which put us over 100 royalties in aggregate. And then we bought Golden Valley and Abitibi, which gave us another 80 or 90 royalties. And now we have 191 royalties across the Americas. And the cornerstone assets within that portfolio will provide cash flow for decades. That includes a royalty on Canada's biggest gold mine, Canadian Malartic, and also a royalty on the U.S.'s biggest gold mine, Goldstrike, on the underground extension of that, which Barrick is in the process of drilling out and incorporating into their mine plan. So we have foundational assets which provide us cash flow today and cash flow growth well into the future, which is why we had the confidence 9 months into our existence to inaugurate a dividend this week of $0.01 per quarter, just under a 1% yield. And that's a record for any new fledgling royalty company in terms of the speed of establishing that cash flow profile, but importantly, sharing that with our shareholders, that annuity with our shareholders, and paying them back capital already 9 months into our existence.
Well, there are other royalty companies out there. So how would you compare yourself to some of the other big players?
Well, it's a very interesting landscape because there's a huge divergence. There's the large cap players, and there's only 3 of them: Franco-Nevada, Wheaton Precious Metals, and Royal Gold. They're the category killers. They're large. They've got the best multiple in the space, typically 2 to 3 times net asset value, lowest cost of capital. They're behemoths. And then there's everybody else. Everybody's around $1 billion market cap, and many of them are far less than that. And it's a very segmented end of the barbell. And the reality is there's no mid-tier in the royalty space. There's a vacuum there. And what we're endeavoring to do through our roll-up strategy, through picking up our competitors and creating scale quickly, is filling that void. We want to get to ultimately at least $5 billion market cap, which is big enough to matter to institutional investors, but small enough to grow meaningfully, because there's nothing those large players can do in terms of individual royalty opportunities that really move the needle for them. At a $5 billion market cap, we can do significant royalty deals that really add significant value on a per share basis and really provide meaningful returns to our shareholders.
Well, are there any analysts right now covering the company? And if so, do they have any price targets that you can talk about?
Yeah, I mean, they can speak for themselves, but H.C. Wainwright and Haywood, and we're Haywood's top royalty pick in 2022. They each have targets that would see our share price appreciate by at least 50%. So they see significant upside. And what they see is the upside in our cash flow profile over the next 3 to 5 years, because we have 6 royalties that are currently in production, and we have 7 other royalties on construction stage projects, which represents significant cash flow growth beyond the next 3 to 5 years. And so that's upward trajectory is really what's driving the interest in both the buy side and sell side in the story today.
And are there any major significant milestones that you want to talk about, or more importantly, what are you hoping for 2022 in the third and fourth quarter?
Well, we hope to continue to grow our business, consolidate further royalty opportunities in the space. As I said, it's still highly fragmented. We want to see more of the players in the bottom end of the sector start to consolidate to create that critical mass, drive up our multiples, drive down our cost of capital so we can be competitive for those large-scale royalties. That's going to be a recurring theme. We have a bid outstanding right now for one of our peer companies, Elemental Royalties, and I'd encourage anybody interested in our bid and the merits of it to read the filings that we've issued under the SEC banner and EDGAR and CEDAR. But that's going to be a recurring theme, I think, over 2022 is further consolidation at the bottom end of the food chain in order to create that critical mass, create that mid-tier that's clearly absent in the royalty space today.
Now, as we said in the beginning of this video, it seems we are heading into uncertain times. I mean, we're not exactly sure what's going to be going on with the Russia and the Ukraine at the border, what's happening at the Canadian border. And I know you don't have a crystal ball or anything, but if things do continue to go bad with the supply chain breakdown in Canada, with COVID, with maybe potential tensions in the Middle East or even in Russia with Ukraine, what's that going to do to gold prices, and should investors be thinking about that moving forward?
Well, in an inflationary environment, in an environment where equity valuations are extended beyond recognition, when you have global uncertainty, political uncertainty, political risk, regulatory risk, people flee for safety. They flee for security. And gold has been a currency for 4 millennia. It's the one currency you can't print. There's a lot of excess in the system, and I think increasingly investors will be looking for that safety and security to preserve the capital they've spent so many years earning.
Yeah, well, I know viewers of this channel are looking at this very seriously because they see what's coming down the pike, and they know it's time to start moving their assets into more safe havens. What's probably the best place for people to go online if they're just finding out about you guys now, and if they want to learn more and get involved?
Well, it's easy to remember. goldroyalty.com is our website. So there's all sorts of information on our prospects, also on the bid for Elemental if you're looking for information on that. And again, CEDAR and EDGAR has many of our filings as well. Please visit those sites and you can learn more about the company. And of course, we have a general email if you want to reach out to us directly, 1-800 number, and we'd be happy to call you back and answer any questions you might have.
Perfect. Well, I want to strongly encourage everybody to check out the links in the description below. We are certainly moving into very troubling times, uncertain times, and historically, when we're in these difficult times, moving your assets into a safe haven such as gold is really a safe bet, a good way to go. And that's something I've been telling you guys to do for quite some time. I hope you've been listening. Once again, if you want to learn more from David Garofalo and Gold Royalty, please check out the links in the description. Once again, thanks so much for breaking this down again for us today.
It was great to see you again.
We all want truth. The truth will set you free.